Good morning, Andy. We're here today to solve the mystery of why, what is going on in the world of bonds. Treasury bills, bonds. Bonds are down. Let's say bond funds are down.
Yeah.
Treasury bills feel like they're up. What we see on our statements are confusing, and so it's confusing to me. I brought you in the big guns and to try to help explain what's going on, because it's really fascinating for me. We won't get into the weeds too much today, but we want to try to communicate what's going on in the bond market, because it is interesting, painful at this time, but we're going to talk about the background. Why is this happening? What's going on in the economy? What does the Fed have to do, and some of those background, because I think that gives a good perspective, Andy, for our clients of when we understand something, we can kind of stick to our game plan a little bit better. And then we'll go through and, that's kind of part one. Part two will be kind of like, why would we own bonds? Should we own treasury bills or regular bonds in a mutual fund / ETF? What's the difference? Maybe get into a little bit of that, although that's kind of technical as well. And then finally, I want to kind of share with clients and people out there how to think about where bonds fit in our investments and what purpose do they serve, and where the rubber meets the road there. So those are kind of the three main parts that we're thinking about, Andy. But what do you think, man? Is this some strange times or what?
Well, it sounds like a good agenda, Charlie, and
Yeah.
happy to join you so we can try and hopefully make some sense of it. But I think maybe strange times. I think what we might find is maybe the last 10 years were strange times, and we're maybe normalizing ourselves a little bit.
Oh, there you go. Yeah, that's a great.
That can be a little painful. But it's zero forever is not necessarily a great interest rate environment to be in.
Yeah.
But excited to jump into all those topics.
Yeah, you're right, man. You nailed it. It's like this transition period is maybe getting back to normalcy, but the transition is painful. And it's kind of reminds me like back in the 80s when they talked about creative destruction, in these businesses that went out, but it's just this transition period. So first we're going to, we talked about the relationship price and yield between bonds. This is important. So what do you think here about this relationship?
Yeah, Charlie, thanks for bringing this slide up here. So I think, before we even jump into, hey, what's happening in the bond markets, like what happens to the prices of bonds in relationship to interest rates? I'm convinced it's the most quoted line in the Wall Street Journal. You read it every time. As interest rates go up, bond prices go down. And it's literally in every article I read in the Wall Street Journal. And they put that in there because it's a complex and often misunderstood dynamic about bonds. So to break it down, right, I think a lot of us have seen, we're in 3 years in a row almost of the bonds going down in value. Like, well, how is that possible with yields going up? This doesn't make any sense. So simple way to think about it is if you own a bond that has a coupon, or in other words, just an interest rate that it pays every 6 months of, say, 2%, right? So 2%, you get a check in the mail from that bond, whether that's a U.S. Treasury or a corporate, and it pays you. And when that bond was issued, the interest rate was 2%, right? Because that's generally how it goes. So that bond gets out, it's 2%. Well, now bonds are, say, 5%. So if I'm Andy and I'm going out and I'm like, God, what did I go buy a bond today? Let's see what I should go buy. And I have a 2% bond and a 5% bond that's just getting issued, and they both have the same maturity. In other words, they both, the principal and everything gets paid at the same day. Well, I'm going to go buy the 5% bond, right? And say, Charlie, let's say you own the 2%. Well, that kind of stinks for you because you'd like to sell your 2%. So how do you convince me to go buy the 2%? Well, you've got to lower the price on your 2% bond so that I can get a 5% yield on your 2% bond. So it's kind of the law of one price out there. All things being equal, that 2% bond has to give me the same return as a 5% bond. And in order to do that, you've got to entice me to buy the 2% bond. The only way to do that is to lower the price of the 2% bond. So then, Charlie, I'd be happy to buy your 2% bond from you if you can just lower that price for me.
Yeah, that's what we're seeing right now. I think the important part about that point is in a bond fund, people are seeing the price impact more, I think, than they're seeing the interest rate goodness, let's call it, because that's a
Yeah,
positive thing for bond funds. But right now, when I look at my statement, all I see is that price decline, and it's very frustrating. And what I
sure.
don't see in the bond fund in my portfolio, I don't see that benefit of that future yield yet. We'll talk to that in a
That's right.
second.
That's right.
I might be getting ahead of us, but when I look at an individual treasury bill, let's say, all I see then is the interest. And I'm like, that looks
Right.
awesome, 5%, but I don't see a price fluctuation. And so it's a little bit, to me, it's confusing in that regard. What do you think, Andy?
Yeah, it's a good point, Charlie. If you buy an individual bond, right, I think most people understand that you lock in that yield because you paid a certain price for it, and then you get those coupon payments over time for that bond. So you lock in that yield. Whereas, as Charlie, as you mentioned, right, that bond fund's going to go up and down in value.
Mm-hmm.
Well, the dynamics interplaying here are essentially identical between the two. That
Mm-hmm.
bond fund manager just has a portfolio of those individual bonds,
Mm-hmm.
and those individual bonds are going down in value as interest rates are going up. But what that bond fund manager can do is then, Charlie, to your point about, hey, how can we get more yield, or what's the silver lining here? Can go out and buy more bonds at a 5% rate. So they had 2%, they mature, they get to go out and they buy 5%. So that bond fund, even though, yeah, prices may be going down on that bond fund, should be giving off more income because you have more bonds that have a higher coupon or interest payment over time. So I think the takeaway here, Charlie, is bonds, individual bonds and individual bond funds really are the exact same thing. There should be no distinction between the two.
Mm-hmm.
It's just how it's presented to us as investors that can
Yeah,
be somewhat frustrating
absolutely.
um,
Yeah.
associated with that.
Yeah, absolutely. Let's see what the next slide has for us here. This is a fascinating one that we talked about yesterday. But what's your
Yeah.
takeaways from this slide here, Andy?
Yeah, my takeaway, first of all, is if we think about, hey, why are interest rates rising? And we talk about interest rates rising. I think everyone is familiar with what the Federal Reserve is doing,
Mm-hmm.
right, to combat inflation. They're going to raise the short-term interest rates. And that's exactly what this chart is showing, right? You can see starting in 2021, as inflation was going up, we started rising rates. So we were in this really basically since the global, yep, that's exactly right.
Yeah,
Since the global financial crisis, we were in this almost zero interest rate environment. They
mm-hmm.
tried to raise it in 2015, and then COVID happened, and we went right back down.
Yeah.
So that's how the Fed tries to control inflation at a very broad level.
Mm-hmm.
And so what we saw was investors were expecting that at some point, like we see in all of these, big peaks and then dips,
Mm-hmm.
at some point the Fed was going to have to then lower interest rates in response to the economy.
Mm-hmm.
And so because of that, if you think about, well, in the future, if rates are going to be lower than, say, on a 10-year treasury, then I would expect that yield to be a little bit lower. Well, the problem is now investors are starting to maybe call the Fed's bluff, if you will, and say, I think rates are going to be higher for longer.
Mm-hmm.
In other
That's the
words,
sign,
the
right?
economy is doing very well. Yeah, that green line right there, the market expectations, which is just a way of saying what's being priced into the market and into the yields currently. And the economy is still doing well. And so investors are saying, I think we're going to be in a higher interest rate environment for longer.
Mm-hmm.
And because of that, then they look at the longer dated bonds, say a 10-year treasury, which is what's been in the news recently, and say, well,
Mm-hmm.
for me to hold that 10-year treasury, if rates are going to be higher, I need to demand a higher interest rate on that today for me to go out and buy that today based on my expectation of the future.
Yeah. Yeah. It's interesting. This chart to me is fascinating too, like we talked about earlier, or you mentioned earlier. Hey, this is somewhat a return to normalcy.
Yeah.
This is not normal. This vertical, almost direct vertical line is unprecedented in our bond history, and that there's a
Yeah.
lot of reasons for that. There's almost a perfect storm, if you will. COVID had a little bit to do with that as well. But nonetheless, people say, hey, why didn't we see this event coming? This is just interesting. But, after in 2009, there's a chart out there that exists, and it shows that starting in about 2009, after the Great Recession, 2008, every single year, if you drew the expectation of interest rates, it'd be like this. Every single year, we expected the rates to go up like they did finally in 21 and 22, and maybe even, like you said, 16, 17 here. So it just is a fascinating history that kind of led up to these points here. But in the big scheme of things, I like what you said. It's like an adjustment back to normalcy. This was quantitative easing. Everybody remembers quantitative easing, how, Fed's pumping money into the economy. They're pumping money in the economy. They're propping up the stock market, and it's going to lead to bad things. Well, I don't know that it led to this specifically. There were a lot of things that led to that. But but now the Fed is doing the opposite. They're not pumping money into the markets. They're taking it out of the markets by raising those rates. So in a way, again, like you said, to your point, return to normalcy. But we're gonna feel a little bit of pain in this transition. Is that kind of the right way to say those things, Andy?
Yeah, I think that's spot on, Charlie. And I think the other piece you bring up about, you showed the arrows, and hey, everyone expected rates to go up here and then here and then here. Well, that's if you're somebody who in 2010 said I need to be on the short end of the yield curve or in all cash because rates are going to go up, and that means bond values are going to go down. Well, you missed out on years and years of bond returns and higher yields. So just that's a long way of saying, market timing. We always talk about that in the context of the stock market, right? Should I go buy more NVIDIA or Tesla?
Yeah.
But that same dynamic of market timing exists in the bond market, right? And just like it's challenging to predict the future of the price of Tesla, it's just as challenging, if not maybe harder, to predict the future interest rate environment and to try to time your bond portfolio based upon that, right? So I think that's a great point.
Yeah, one of my favorite commercials, Andy, was it was a bank commercial of some sort, and they brought out this Nobel Prize winning economist and set him on the center of the stage. He was the only one, and they said, today we're going to ask the smartest person in the world this very important question. They said, sir, when is inflation or interest rates going to go up? He said, I don't know. And then that was the end of the commercials. Nobody knows. But anyway, maybe not everybody else's favorite commercial, but I thought it was kind of funny.
It's a good one.
Yeah. So another slide here, just about putting this in historical context. What's your takeaway here?
Yeah, so just to cage everyone's brain here. So the dark blue line, that is the historical nominal 10-year treasury yield. So in the previous slide, we were talking short-term interest rates or federal fund rate, and that was the longer dated bonds, their treasuries. The gray line is just is the real yield, essentially taking into account the impact of inflation on the purchasing power of that bond. So if you look at it, I think there's been a lot of talk of, hey, we're in this unprecedented interest rate environment where that says 4.92. It's probably closer to 5, but that's from just a few days ago.
Yeah.
And if you look historically, this is since 1958, so quite a bit of data, right? We're really right at our average 1958 to present. You can see on that box there, Charlie, if you want to circle those nominal yields average, 5.76%. So if you think about it, we're kind of into that, I'd say, that normalization period and getting out of this zero interest rate environment for indefinite periods of time. And so that's the takeaway here for me is I think the markets get spooked when things happen quickly. When we see a really aggressive rise in interest rates, Wall Street doesn't appreciate that, but really what we're seeing is kind of trending back towards a normalcy. And I like that. The other thing, if you look at that gray line, I can now get a real positive return on my fixed income investments. In other words, holding bonds isn't a loss from a purchasing power perspective. And I can maintain purchasing power now. In other words, the income that I get, off of that bond keeps pace with the price increases
Mhm.
and inflation. So all those things are good. If I'm a bond investor going forward, I'm actually pretty happy about this. Right, this is a better environment for me to hold my bonds in.
Mhm. Yeah. Yeah, it's amazing how we are swimming in these waters or have been the last couple of years, high
Yeah,
inflation, uh, and it starts to mess with our psyche a little bit because we take this recent information, again, what we see on our statements, and we project that forward as if that's the future, when in reality it's not. So it really can mess with us a little bit, but that, let's see here. That is a good segue to this one. We've that's kind of our part one, Andy, where we kind of
yeah.
lay out this background of why interest rates are moving a little bit, or what's the history and perspective, if you will. Hopefully that's helpful.
Leading Edge Financial Planning, LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Leading Edge Financial Planning and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.leadingedgeplanning.com. The information provided is for educational and informational purposes only. It does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor. The views expressed in this commentary are subject to change based on market and other conditions. These documents may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from these projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur. All information has been obtained from sources believed to be reliable, but its accuracy is not guaranteed. There is no representation or warranty as to the current accuracy, reliability, or completeness of, nor liability for, decisions based on such information, and it should not be relied on as such.